Absolute honor to have Richard Pzena here with us today. Richard Pzena is the founder, managing principal, co-chief investment officer, portfolio manager, and member of the Pzena Investment Management Executive Committee. Mr. Pzena is the architect of the firm's investment strategy and conceived and developed the firm's proprietary screening model. He serves as co-portfolio manager for the U.S. large cap and mid-cap strategies, focused value, and U.S.-based idea funds. Mr. Pzena began the firm in 1995. Prior to forming Pzena Investment Management, Mr. Pzena was Director of U.S. Equity Investments and Chief Research Officer for Sanford C. Bernstein & Company. He joined Bernstein as an oil industry analyst and was named to the Institutional Investor All-America Research Team for 3 years running. Mr. Pzena also serves as Chief Investment Officer of Small Cap Equities. Prior to joining Bernstein, Mr. Pzena worked for the Amoco Corporation in various financial and planning roles. Thank you for joining us here, Mr. Pzena.
My pleasure. My pleasure. Thanks for having me.
Excellent. Thank you so much. So let's dive into the questions. So our first question is says General Electric has struggled with profitability in recent years. What actions could the company take towards improving the profitability of the business? Should the company sell off any of its subsidiaries?
Well, look, General Electric is our largest holding. I'll start there. And I'll put a little context around that before I actually dive into the details of this company. Because we're traditional old-fashioned value investors. And what that means is paying particular attention to the price that you pay. And, having done this for 25 years in this firm, 10 years prior, and 10 years probably before that of just being interested in the markets, one of the things you get to understand is there really are no free lunches. I mean, everybody wants to buy great businesses for low prices. The problem is that great businesses don't sell for low prices because we all look for the same kinds of characteristics. We all look for good earnings growth, high margins, great franchise, good management team, clean balance sheet. These kinds of things don't sell for a low price. So if you care about the price and you want to buy a good business, the only times you really get to do that is when something goes wrong in that business. So GE is a prime example of things going wrong. I mean, over the last 10 years, GE had repositioned itself as a financial services firm, built up GE Capital, paid less attention to the industrial businesses, and then bore the brunt of that pain over a 10-year period of restructuring, where GE's share price, probably if you measure it from its all-time high till its low in 2020, fell 90%. So the question you have to ask yourself is it a good enough valuation so that I think I'm getting these businesses which are pretty good? So let's look at what they are now. Because over the last decade, GE has shrunk. Its financial services business is a very small fraction of what it used to be. Its sprawling industrial conglomerate is down to 3 primary businesses. Generally speaking, all of them you would think are great businesses. One is struggling the most right now. That is the jet engine business. And you can understand that. So this is a COVID issue. GE's engines are on 50% of every commercial flight. And pre-COVID, they were on 65% of every new delivery of airplanes. They make their money keeping the engines running, not selling new ones. The overhaul and repair and maintenance business, the spare parts business, is very, very high margin business. And so it has historically earned 20% margins. So almost everybody pre-COVID would have said, this is a great business. Air travel had been growing above the rate of GDP growth globally for 6 decades. And the more money people had, the more they traveled. The 2 competitors it has are substantially less profitable, with the third, Rolls-Royce, flirting with bankruptcy several times in its history. So now nobody travels. So you can imagine the economics, because not only do airlines have a 50% reduction in their number of departures, but they drop their maintenance spending by more than 50%, because you fly the planes, you fly half the planes, and when they reach a maintenance event, you just park them and take another one out to maximize your short-term viability. So what do? Well, they did what anybody would do if you were running the company. It's not rocket science here to say we have to cut our costs. And if you were looking at this pre-COVID and you saw this big revenue decline, and we forecast actually that GE would burn through $7 billion a year in cash given the revenue decline, if they didn't take any corrective action to stem the outflow. And they had about $50 billion of liquidity between cash and credit lines. So we thought, okay, you got 7 years for this to recover. The stock, just to put some perspective on it, when it got to its low, if you made a rough guess of how much money they would make selling engines, assuming they downsized their cost structure, but that air travel never recovered, you would get something like roughly 75 cents a share of earnings once that happened. Now, they were losing $7 billion a year, or so we thought. By the time the fourth quarter hit, they were actually cash flow positive. So it took them less than 9 months to right-size the company to the point where it wasn't hemorrhaging cash. And so they never had to test their viability. But you were presented as an investor with this really interesting dilemma, right? If I could buy a stock for $5, air travel never recovers, and they move their earnings back to 75 cents a share, I'm earning 15% per year return on my money. Plus, there would be some growth, even if it was only at the rate of inflation or GDP. So you could say, look, in the worst case scenario, I've locked in 20% a year for the rest of my life owning GE. And if they recovered back to their historic norms of profitability, and by the way, the company's plan is to recover with a higher margin than they did in the past. I happen to believe that's believable, maybe not their targets, but if you do an upside case, you were locking in 30+% a year lifetime returns owning one of the best businesses out there that happen to be struggling. So I apologize for the long-winded answer for the first question, but I wanted to set the stage of how we think.
Yeah, I think we really appreciate that analysis. It's very helpful. Can you discuss a little bit how you analyze companies that are banks or insurance companies?
Yeah, analyzing a business, what you find is they're all the same. They have revenues, they have pricing, they have costs. They just have different words for those things. So a bank is really two businesses combined, a deposit gathering business and a lending business. It's actually, and this is what people don't understand, the deposit gathering business is really the spectacular part of the business. Lending is a commodity. If you want to grow a lending business, it's very easy. Just lower your interest rate and you will make all the loans that you want in the world. Getting people to pay them back is a little trickier, but growing a lending business is about as easy a thing as you could possibly imagine. Growing a deposit gathering business is very, very difficult. And taking away deposits are very difficult because people, they don't have any reason to change. You set up a banking relationship. I've seen some interesting analysis that shows that bank loyalty of companies to their banks exceeds almost any consumer or industrial product. People don't switch their bank accounts unless something happens to piss them off. And so you that you willingly give your money to somebody at below market interest rates in order to get the services they provide. Now, when interest rates are zero, it's a very challenging business for banks. When interest rates, and what I mean by interest rates are the federal funds rate. When the federal funds rates exceed 1%, the banks are printing money because effectively they're paying you zero and the value of those is at least 1%. They can also lend it at a premium, but they also incur loan losses in that. And so when banks, when net interest margins or the deposit spread is wider than 1, bank earnings are very, very profitable. So how do you analyze it? And this is obviously, this is a key question because everybody looks at this and says, this is unbelievably complicated. How do I know who they're lending money to? How do I know what crazy derivatives they're investing in? You sort of feel like you don't know anything. However, if you looked at bank disclosure, what they are required to produce, I mean, the annual reports are this thick because there's massive amounts of data on the types of loans they make, the sensitivity they have to interest rate moves, the history of loan losses, and you can be thoughtful. So let me just give you the analysis, again, the COVID analysis. Because banks, when we hit COVID and we were going to this big economic downturn, everybody panicked on the banks. They said, who's going to pay them back? Nobody's going to have any money to pay them back. The credit card companies got hit the most. So Capital One, for example, is one of our largest holdings. Capital One has built, credit cards are also a good business because it's a scale business and acquiring the customer is difficult. I'm sure you've been, you start from the time you're like 15 years old, you start getting solicitations for credit cards. It's very hard to dislodge people from their existing credit card business relationship. And so the margins have typically been quite high for the people who have the scale. But unemployment was always the biggest risk because if people lose their jobs, they can't pay back their credit cards. Interestingly, one of the things that we first observed in, I'm going to say, April of last year was that, and this is somewhat unfortunate, but the people who lost their jobs tended to be on the lower end of the income scales. They were people who worked in restaurants, worked in hotels, and it was very, very different from a typical recession. Most banks use like models to predict their loan losses, and they model it based on the unemployment rate. But this time the unemployment rate gave you the wrong indication because the people who were making minimum wage had much lower credit card balances than the average. So they massively over-reserved. And that gave you an opportunity to buy these businesses at valuations that were really, really spectacular. So while it sounds like they're complicated and the thickness of their reports are complicated, you pretty much understand there's a deposit relationship. They either make a loan on a credit card, they make a mortgage loan, they make a commercial mortgage loan, they finance working capital. These things are not that complicated when you start to actually think about them, and you can analyze them like any business.
And is your thinking similar on insurance companies?
Absolutely. You think about insurance, there's really two main kinds of insurance, life insurance and property and casualty, which have very different characteristics. So again, when interest rates got low, people got scared about life insurance companies because it's a very long-tailed liability. Somebody writes a policy, they may not be dead for 40 years, and you have to invest this premium. And if your interest rates are lower than what you expected them to be, you might not have enough money. Interestingly, though, when you analyze how slowly the interest earnings run off of a financial institution because they've made long-term investments. They don't make short-term investments. When the stock prices start to get low, particularly below book value, when you do the arithmetic, the fact that it's a very long tail to wind down gives you a huge amount of headroom, and it's actually almost impossible to come up with a scenario where the shares were overvalued. And if interest rates rebounded, you would make a lot of money. That's what, by the way, you'll keep hearing the same kind of analysis. We're looking for skewed outcomes. If things stay bad, you don't lose a lot of money. And if things turn back to the historically good, you make a lot of money. And that's what it's all about. In property and casualty, typically they're shorter cycles. It's not as much of an investment analysis. It's more, what's the cycle? And you tend to have what they call hard insurance markets and soft insurance markets. Really, it means that your premiums are going up or going down. And it's very competitive. And when you have a lot of stress on the insurance industry and their reserves are depleted, they tend to raise their prices because nobody has the capacity to write the insurance when their reserves are depleted. So you get these cycles. And that's how you would analyze a property and casualty company.
Wow, that's very interesting. Thank you for sharing your framework on those. And just returning to the discussion of banks for a second, what are your thoughts about Citigroup's recent management changes and their intention to sell most of their Asia division? And when do you believe Wells Fargo's asset cap will be lifted?
I mean, I'm just going to make up stuff to answer that question. The reality is neither of those things matter to the investment decision long term. What matters are what are the good franchises that these companies have built over the years that are difficult to penetrate. So in Citigroup's case, one, it's a credit card business that's global. They're one of the few players that have penetrated the market outside the United States in the credit card business because they started 50 years ago. And they started building these businesses when there were no computer credit scores where you could just look up a credit score and decide whether to make a loan to somebody. You had to learn the hard way by gathering your own proprietary data. And they had branches in emerging markets, for decades, and created these relationships with the consumer that gave them this unbelievable business. They did the same thing in the global cash management businesses. So if you're a multinational, now we're going away from the consumer and going towards the corporate customer. If you're a multinational company that has to deal with different currencies, there are only a handful of banks that can handle your business. So Citibank has become the largest foreign exchange dealer. And what's interesting is the margins and the return on capital you earn as the go-to player of scale are just substantially better. And anybody who wants to enter that business, they try. It takes years and years and years to do that. So yes, the new management's turnover. We get to talk to the management, hear what they have to say. I'll relate an interesting conversation I had with the prior CEO. And this was when we were talking about fintech, okay? So I'm going to guess that I had this conversation about 2 years ago. And he was talking about 4 years prior to that. So call it the mid 2015, something like that. He was describing this era of, we had an endless stream of 28-year-old CEOs of startup fintech companies coming into our office saying they were going to put us out of business. And I would think to myself, you seem like a very, very smart, enterprising individual. Why do you want to be a bank? Do you even have any idea what a bank is? He didn't say these things, he would think them to himself. Because being a bank and being a tech person don't really go together, because a bank is a highly regulated institution that exchanges its freedom to get the blessing of the Federal Reserve, and they take the regulation. Tech companies are the opposite of that. So he said 4 years later, now you go back to 2 years ago, there's a new crop of 28-year-old CEOs of startup fintech companies coming into my office to sell me their businesses because they figured out that they're going to make a lot more money than to be regulated by the Fed and accept deposits. So what's happened is technology actually has strengthened the biggest banks because they're the ones that have the money to buy all of this technology. And today, when you look at the propensity of younger people to open a bank account, they tend to do it with one of the 4 big banks because they're actually better. The technology is actually better because they've written big checks to buy it.
Yeah, that makes a lot of sense. Thank you for sharing your analysis on that. And how do you look at pharmaceutical companies when considering investing in them?
Yeah, pharmaceutical companies are an interesting dilemma, and I've gone through years and years of developing my thoughts on this. You know my background, you read my background. I had an oil industry background, and I always thought that the pharmaceutical industry was like the oil industry. Now, that's going to sound a little crazy to you, perhaps, but you have all of these existing oil fields, and then you explore for new ones. In a pharmaceutical company, you have all these existing drugs, and then you're trying to find the next one. And you spend a lot of money on things that don't succeed. Same thing happens in the oil industry. But by the way, as the technology gets better, the chances of the probabilities of success on those investments have improved. But the reality is there's some speculation. And I always ask myself, does the fact that one company have a lot of good drug discoveries tell you anything at all about their ability to find new drugs? I'm actually not convinced that it does. I think what the pharmaceutical companies have is the ability to manage and distribute a complex product through a very carefully honed sales force and distribution process, so that when somebody comes up with new technology, they can buy it and plug it into their distribution system. That's really the value. When you start speculating on who's going to come out with the next drug, I don't know how to do that. And we leave that to the growth stock investors. What we would prefer to do is value the franchise, which is the relationships with distributors, the relationships with doctors, the relationships with hospitals, the marketing prowess, the scientific ability to select. These are the things that you can look at as a franchise. And that's how we would think about a pharmaceutical company.
Yeah, that's very interesting and helpful. Thank you for sharing that. And then going back to our discussion on oil, oil is an interesting spot right now because on the one hand, over the very long term, there probably will be declining demand. But on the other hand, there's such a negative stigma against it and against drilling that banks are very hesitant and other financial institutions to give money for investments in new wells. So what's sort of your outlook on oil and how to invest in oil companies?
It's very interesting what's going on because the political response to oil is the short-term political response to oil is to discourage investment, right? That almost by definition has to lead to rising prices, because if you think about this, if Biden cancels the Keystone pipeline or doesn't allow leasing of oil properties, the Midwestern American driving his Suburban is not going to stop driving that Suburban. I'm pretty sure of that. And so the price has to go up. And then if the banks don't provide third-party capital, or the private investment players don't provide third-party capital, then then the oil companies have to have enough cash flow from selling oil to be able to reinvest. Now, there was a very interesting piece, and there might be a little background noise, so I apologize for that. BP puts out an annual report called the Global Energy Outlook. I've been reading it for 30 years, since I was an oil analyst. It's written by their economics team. It's not a political or a sales document. It's just their economists writing. So they decided to look at the biggest negative carbon case they could think of. And the way they thought about it was, let's look around the world and see who gives the biggest incentives for electric vehicles, for an example, and assume that every country gives those same incentives. Let's look at the biggest penalties for carbon emissions that we've ever seen and assume that every country adopts that. And then they look forward for 20 years. And this is what was really interesting. They said that in the next 20 years, the industry still has to spend up to $20 trillion to meet the declining demand for oil and gas. And to me, what was fascinating about that is that's more than was spent in the last 20 years. So there's a long way to go. We're going to be consuming oil for 20 or 30 more years, natural gas for 30 to 50 more years, because we're going to use it to make electricity. We still have to eliminate all the coal in the world before you start eliminating the natural gas. And so there's not 30 years of oil that's been evolved. So the price has to be high enough to stimulate the spending that will be done. Now, this is, for the people that are socially conscious, they think of this as a horrifying concept. How could you invest in a business that contributes to polluting the world? But the reality is, if the world didn't have oil and gas and you shut it off immediately, it would be unbelievably burdensome to society. And so the transition is how you have to think about this. And every oil company thinks of themselves as a transitional business. It's just a very, very long transition.
Yeah, that's very helpful. Thank you for sharing your thoughts on that. And can you discuss the impact that you believe that increased public healthcare and healthcare regulation in the US will have on Cardinal Health?
I don't think that regulation is the issue for Cardinal Health, okay? I think the issue is Amazon. Cardinal Health is a drug distributor. Basically, they would hate my description of their business, but they drive pills in a truck from a warehouse to a store. That's what they do. Now, it may sound more exciting than that, but it's not. Now, the question is, are people going to bypass pharmacies and order directly to their homes? So obviously Amazon's interested in this business, and they've made some acquisitions, and they're at the peripheral. But right now, the drug distributors, there's 3 that have 90% of all the business. That's because it's a business that needs scale. remember, you're driving little bottles of pills that have a lot of value. So you don't need a very high margin. So you can make, let's call it $1 a bottle of pills. And unless you can fill up the truck, you can't be competitive. So somebody who tries to do this and duplicate it winds up not succeeding. That's why it's consolidated down. It's a natural oligopoly. So can Amazon bring these things to your home for cheaper? Now, I've seen all kinds of analysis. And the real answer to that question is, if they're already going to your home every day, then you can conceive of this. Doing it in a vacuum, you could never conceive of this. So will this wind up being an issue? Yeah, it will long term. But again, this is a very, very, very long term.
Yeah, that's very helpful. Thank you for your discussion of the risks for that company. And what events do you believe have been the most influential in your investing career?
Well, there's a few of them. I'll start back, all the way back, because the reality is you're either born a value investor or you're not. So it goes back to my mother. You know, when we would go to school every year and we'd see all the neighbors in their brand new school clothes, and my mother would say, we're waiting till they go on sale. They're going to be exactly the same clothes if I buy them 2 months later, and you can deal with that. So, you know, I've had that mentality my whole life, that the price matters. And when you organize that and you're really a bargain hunter, so I'll give her some credit. I'll also say that, you know, I've read a lot. When I was doing my studies at Wharton, and you have to give yourself some perspective on this. This was in the late 70s, when access to big databases of computerized data didn't really exist. We had paper stock guides. So me and two partners decided to redo the original work that Benjamin Graham and Dodd did, you know, in the early 1900s, manually. And we concluded that everything that they did still worked. So I convinced myself there. And then I went to work for a firm, Sanford Bernstein, that was a classic value investor, reinforced my skills. They had a view that it doesn't matter what you buy as long as it's cheap. If you can buy something for half price, it doesn't have to be that good. Just buy it for half price. And I always believed that. And then I met one of the gentlemen who has become very famous, a man named Joel Greenblatt, who's written books, and I don't know if you've interviewed him or not, but you should. And he challenged me when I was leaving Bernstein. He said, go back and look at your 10-year record at Bernstein and eliminate from your portfolio the 1/3 of the companies that had the lowest normal return on equity. Normal meaning when things recovered back to normal, not their depressed levels. And I said, oh, it's not going to matter because I'm buying half price is half price. It doesn't matter whether it's half price of something good or half price of something bad. And I did that, and I was completely wrong, right? You would have added a huge amount of value by eliminating the companies that had the lowest sustainable profit structures. So that was a seminal moment in my thinking. It also gelled to say, you don't get to buy the best businesses. The problem is you can't go the other extreme because the best businesses get priced up. So it's not like linear, it's more like parabolic. The worst companies are not that good. The medium companies are pretty good, and the best companies are too expensive. And so the sweet spot is the midpoint. And then the last thing that I learned more recently, and this was a part of the financial crisis, is financial leverage, excess financial leverage, is not your friend as a value investor. And what I didn't realize is how really clear that is. Because when things get stressed in a company, rationality gets thrown out the window. And people behave emotionally and do things that are not necessarily in the long-term interests of the company just to get through the near term. And they wind up destroying value. So you really don't want to buy the most levered companies, but similarly, you don't want to buy the least levered companies because they're either too expensive or they're leaving money on the table, and the sweet spot is in the middle. That's what you find a lot. So those are the kinds of things that I've adapted as I've aged.
It's very interesting. Thank you for sharing that. It's also very helpful. And what does a typical workday look like for you?
Well, I'm completely an early bird. Like, you're getting me at the time of day when I'm totally spent. So I always wake up in the middle of the night. I'm not saying that this is a good thing, but like from 3 to 4, I have all my best ideas. And I write them down. So I have like an iPad or a phone next to my bed. My wife's not too happy about it, but, and people get emails from me in the middle of the night. So they think I work all the time, but really I go back to sleep after that. I wake up and I think that physical exercise is as important as mental exercise. So my early morning, you know, I'll get up at 6:30 in the morning and I spend an hour in the gym almost every day. Now, my day has evolved a lot as my life has changed. So when I started the firm 26 years ago, we were like 4 people, and we spent all of our time thinking about investments in the market because there was nothing else to do. I mean, there's no administration in a small company. It's an easy business when you don't have any customers. And over time, things got more complex. So I would say you introduce clients into the mix and they want you to talk to them. So I went from, call it 95% investor and 5% everything else, to 75% investor, 20% talking up to clients, and then 5% everything else. And then the business started to get more and more complicated, and we started to invest outside the United States. I think that I saw one of your questions about inside versus outside. The reality is we're way bigger outside the United States than we are inside. So today we are probably 2/3 of our investments are outside the United States and 1/3 are inside. And, you know, we manage over $50 billion. So we have a US portfolio, we have a European portfolio, we have an Asian portfolio, we have an emerging markets portfolio, we have a global portfolio. It's not humanly possible for one person to oversee all of that. So you start creating more administrative structure and delegating more and more. So today, my time focused on investments, where I'm purely the responsible party. where I could talk to you in the way I analyzed those US companies you asked me about, that's probably a third of my time. I spend another third of my time listening to what's going on in other parts of the world, even though I don't make the investment decisions on those, and chatting with the investment people so it's more of a management job, I'll call it, than a real investing job. But it's interesting because you get to sit in on all the meetings with people that have doing all the research. So even though I'm not doing it, I'm in the flow. And that keeps it very, very interesting for years and years and years. This is one business that you can do a whole career and never get bored because it's always different stuff, always different stuff. So I don't know if I got at what you're asking, but that's what I thought you wanted.
Yeah, exactly. That's exactly what we were asking for. Thank you. That's very, very helpful. And students would like your advice on several categories. So the first is, if they aspire to start a fund in the future, what is your advice for them, especially in regards to raising investment capital? And then also if they dream of interning at Pzena Investment Management in the future, what sort of qualities, background, and experiences should they have?
Okay, if you dream of starting a fund, these are the things that you should do earlier in your life. And I had an interesting story that was told by David Rubenstein, that's the founder of the Carlyle Group. And I'm going to paraphrase because it's his story, not mine, but it influenced me. He was a lawyer. He graduated from law school and he went to work for a big law firm, and he was kind of mediocre at it, as he put it. And so he decided to do something else, and he basically drifted. And then in his mid-30s, he read an article that said that 90% of businesses are started between the age of 21 and 36, and he was 36. So he started the Carlyle Group. That's his story about why he started the Carlyle Group. It's funny, I was 36 when I started my firm. And it's really true. The risk rewards get more difficult when you get older because, one, there's less room for making a mistake. You have to be totally willing to fail. It's the most important criteria, and you have to, and this is a Winston Churchill quote, success is going from failure to failure to failure without losing hope and optimism. So you have to have that. And you have to realize that if you fail, the consequences aren't that dire. You just go get a job. That's what you do. If you try to at age 28, you go to work for somebody, you learn from them, you see what they do well, you see what you think you might be able to do better, and you try it. Now, raising money is a lot harder today than it was when I first started. I worried about it. How am I going to ever raise any money? It turned out it was harder to build the investment team than it was to raise the money, because I think they actually go hand in hand, because you really, really, really want to be picky at the people that you affiliate with, because if you tolerate mediocrity in the people that you hire, it will permeate the organization and it will be impossible to get through that. So be careful who you connect with. But the good thing about it is you don't need a lot of money to do okay in this business. And you can start small and struggle, but build a record. And you just have to have a long perspective on doing that. The interning, look, we generally in our investment business are not hiring people right out of school, but we do accept interns, and we accept them generally earlier in their college years, not the year between their junior and senior years, because we're probably not going to offer them a full-time job. So we'd rather give people a chance to see what it's like. And it's easier for us to do it when you're after your freshman year or after your sophomore year than it is after your junior year. So that's what we're oriented towards. Now, we may switch that. There's some desire to actually use it as a screening tool, but we haven't. We've more used it as a, let's give back and help people get some exposure to this business.
Absolutely. Thank you so much for those comments. They're very, very helpful. I want to be very respectful for your time because I know you have a flight to catch. We're really, really very grateful for the time that you put into this interview. And this was a very educational and very helpful experience.
And my pleasure. And thank you for the very thoughtful questions and the work that you did in putting it together. So I enjoyed it.
Excellent. We did as well. Thank you so much. Have a great day.
All right. Bye.